Hey,
Good
Danielle
morning.
DiMartino Booth, how are you? Good to see you.
I'm wonderful. I love to hear that accent of yours. How are you? Whenever I hear your voice, I'm like, okay, put your seatbelt on. You're about to be interviewed by a smart person.
Oh, bless you. All flattery is gracefully accepted. These are difficult times for us. We've just had the FTX platform take a massive number out of us and many of our community. So we've been licking our wounds in this counterparty risk world because we've also been silly enough to play in the crypto space. So and we chose.
Well, then you might not want to ask me about that because I've I've not been privately in our Bloomberg chat room. I've not been very flattering of some of the things that have transpired in the last few days.
No, it's been awful. No, I don't mind. And you know, it's one of these hindsight things. I thought there was some smart people behind him and bigger people. I thought, you know, he's the front guy. You know, it's a bit like Facebook, but there's a whole bunch of, graybeards somewhere. But it seems there probably wasn't at all. And we literally got sucked in. Anyway, yeah, Danielle was a member of the Dallas Fed some time ago and is now behind Quill Intelligence. We're delighted to have her and has a very good insight and read on the American economic system, the Federal Reserve, what goes on. And I suppose to loosen you up, Danielle, as a little loosener for you, which will be easy as cake for you to handle, we had some data yesterday. And it was for the first time somewhat dovish, and as a result, we've had a resulting effect on the dollar. Your take on the data and whether it's a one-off and the inflation has been won. There's going to be a lot of peak inflation callers. I'm not in that group, but yeah, how do you interpret that? Give us your opinion there.
So I actually am in the peak inflation camp, and I have been for some time, simply based on shipping rates from Shanghai to Los Angeles absolutely collapsing to the lowest level since 2009. We're watching import activity in the United States absolutely just crumble. You're hearing from retailers, in the midst of the market melee after the CPI report hit. You had Amazon announce that it was going to be undertaking a major restructuring. That is a very polite way. They're like McKinsey terms for saying we're going to be firing a bunch of people. And by the way, we're only the second largest employer in America. So it's a beyond Silicon Valley phenomena. We're beginning to see it in the supply chain in the sense that now that you finally got the last bit or bob or semiconductor chip, whatever it was that you've been waiting for the last 2 years, it's finally in hand. And that's actually making industrial production falsely look to be stronger than what it is, which is propping up your GDP figure. But that's just because you're clearing out your backlogs. But talk to individual manufacturers, and they're saying, oh my gosh, we're finally catching up with what these back orders that we've had, and people are canceling and losing deposits.
Wow.
That's how quickly the economy is slowing in the United States. And we should not accept a reacceleration just because it looks like the Republicans are slowly and in a very damaged fashion still going to win the House of Representatives. And that means gridlock. And that means no more stimulus checks. The stimulus checks were what created the inflation to begin with. So we've seen gas prices go back up. We've seen oil hit. There's a cold front coming to the United States. There are going to be many scares about heating oil costs, natural gas costs. It's not that inflation is going to fade away, but the underlying dynamics, the fundamentals supporting inflation, those are fading, and there's absolutely nothing anybody can do about it. That doesn't mean Jay Powell's ready to step down, however.
So can I clarify my overall position a little better? So we have a hyper stagflation review, which actually has the economic recessional into possible full-blown, maybe more intense depression part as well in there. But that the stubborn pricing, the volume will thin, pricing will come down somewhat, but will show a very stubborn element because of energies, because of malinvestment, because of underinvestment, and many other things. So we're going to have these kind of dual demons, but a sort of supercharged 70s. Is there some room for that? Or is it's going to be such demand destruction that you actually feel interest rates will be reversed and cut.
No, I don't think we have anything that convenient. And that is what investors are banking on. They're banking on a full-blown reversal. And whether you're measuring company earnings calls, conference calls, there's been so many that have said, we're going to onshore. We're going to bring manufacturing back to the United States. That's fabulous for well-paying jobs in the long run. Not so good for inflation.
No.
On a structural level, we're talking about a structural shift upwards from whatever it was that we were accustomed to, because we're no longer going to be sending whatever it is off to get manufactured in China. That being said, there's this counter movement of the brain drain to India. Nobody wants to talk about it because it's very, very impolite. But when we had this wave of millennials saying, I don't want to go into the office on Friday. I don't really want to work on Monday either. When I am in the office on Tuesday, Wednesdays, and Thursdays, I will need yoga. And I'll need to have full access to all of my social media platforms at will. And you're just going to have to deal with it because I am the employee and you are the employer. Once they convinced said employer that they could work from anywhere, this big light bulb went off on top of the head of the employer. And they went, well, hell, anywhere could be Mumbai. Yeah. And my law library fits on a chip. So I no longer need the paralegal who's left the West Coast, and now she's living someplace in the middle of the country, and her cost of living is much lower. I can just outsource her. I can offshore her. And that's in many ways what we're seeing when we read announcements like Boeing has just offshored 100 people in their finance department to Mumbai. And so that's part of income destruction as opposed to demand destruction that we're quietly seeing, and it will have long-term ramifications for the commercial real estate market here in the United States.
Yes, I think commercial real estate in urban areas globally are under the same pressures generally, with the whole work from home thing as well. But that's super interesting. So what does Jay do? He has essentially a vicious recession rolling into something probably even more damaging than that. Any jobs that are actually coming back are probably in the blue collar variety and low paying. They're not going to be super value, and they're going to lead to higher costs because of labor unions and higher costs. We're actually deglobalizing on that. Instead of taking it to the lowest common cost denominator, we're repatriating it. So that's going to see stubbornly high prices, in fact, because it's going to be more expensive to do. It's no interest rate cuts, but does he continue to hike? What do you see practically happening in December? 0.5, 0.75, or less?
So I think December, and I think the Fed's at peace with this. I think December is going to be 50 basis points. I think it's going to be a 0.5 percentage point. But bizarrely enough, I'm not quite sure why there's this massive amount of debate about it, because it was pretty much broadcast a few months ago. November is going to be 75, December is going to be 50. But by the way, we're not leaving after that. The party won't end. Yeah. And maybe you ratchet it down on February the 1st to 25 basis points, but you're still there. And that's what I think too few investors can quite grasp, is that the message Jay Powell is trying to deliver is not one of, I'm just going to barrel through with 4 more 75 basis point hikes. That's not what he's trying to say. What he's trying to say is, I'm going to get you to a certain pain threshold and keep you there. And that's the thing. If there's no let up, if quantitative tightening continues at 95 billion a month, watch those Thursday afternoon releases after treasuries mature on the 15th or the final day of the month. Quantitative tightening is real, and it is happening. And it is why globally and here in the United States, we're seeing money growth come to a standstill, if not turn negative. So that's a separate phenomena. And I posit that we're going to stay there until at least the middle of next year, unless something spectacular happens or something unspectacular happens on a global systemic type of scale.
I absolutely agree with that, and but that should mean that the reaction on the dollar and on the debt markets, because you're trading 3.8 on the 10-year now, It's all a little bit premature, though, certainly. So even if you are peak inflation, if we get half a point in December, we're already on 4. We'll be at 4.5 Fed rate. Surely this is going to lean on those same debt markets again, and the dollar. I was talking to Tom Luongo just a bit before, and I said it's almost like the Fed are running out in front of an avalanche of rocks and sheet ice. And as long as they're holding the whip handle and as they're the lead hawk, they're not in a good space, but they get to export some of the inflation to the rest of the world. The pound, the euro has to carry it. The minute they allow themselves to be pulled back into the peloton, the pack, a new leader is allowed, they lose all sense of power. It's almost like the brawl, and they got to punch first. They've got to keep punching. Otherwise, they start to lose the fight, and somebody else starts to dominate. Is there some value to that? And how do you... Okay, so inflation's maybe slowed. It's still at 7. And it was Stanley Druckenmiller who said there's never been a point when you've passed 5% that you've ever reined inflation back without having rates that are higher than the inflation rate, which actually at the moment would imply 7.5%, 8% at the current levels as well. Is there going to be sufficient demand destruction that's going to bring that inflation number so much down that 4.5 in December, or maybe even 5 in February, if they did half a point, will be enough?
That's a good question. And even if you're just talking about the core, and the core is what the Fed tends to focus on as opposed to netting out food and energy, even if you're talking about the core, let's just say you get to that 5%. That's twice what it was the last time that Jay Powell tried to normalize monetary policy, twice what it was. And when he did that last time and quantitative tightening was going on, as he says, in the background, things really started to break. Yeah. And we have yet to see the onset of a credit cycle. We just haven't seen it yet. But I dare say it's coming. It's in train. And that's, for all of the drama surrounding the world following cryptocurrency or the stock market on a day-to-day basis, what we have yet to see is any kind of fallout in the credit markets. And I argue that they're bigger, they're badder, and they can do a lot more damage. And I think that Jay Powell is ready to allow a bankruptcy cycle to take place here in the United States. These are the things that, again, most investors are saying won't happen. He'll blink.
Yes, I agree with that. I think the debt markets, and I'm a bit mesmerized. I'm talking through my pockets here in a book because I was very fortunately very early short on TLT. And then I added HYG, which was the junk debt market. And actually it's been resoundingly resolute under the circuit. And I find myself, is this being supported now? Or is this an industry exposure because fracking, there's a lot of energy in it? Maybe you can answer. Why is the junk market doing so well?
I just wrote 4,000 words on this very subject. That's what the weekly quill was this week, was why is high yield behaving so much better, relatively speaking, vis-a-vis investment grade? Maybe it's because the $3.5 trillion triple B market that is one rung above junk is and should be rated junk. Yeah. And maybe we're actually looking at this through the wrong prism. Maybe high yield investors know what they're getting into. They understand the proposition. Dish just sold a couple $1 billion worth of paper with a 12% coupon. You know what? That's rational. Junk bond is actually being priced as junk again with double digits.
Right.
Why are we giving investment grade, which I dare say the credit rating agencies have once again failed to properly rate? They've inflated their ratings. That's why if you're looking at HYG versus LQD, the biggest investment grade exchange traded fund, that may be why. It's not that HYG is so good. It's that we're looking through the wrong prism because investment grade is not as good as it's advertised or rated.
Got you. So then in some senses, the investment grade has the bigger down rating because at least junk is considered junk. While
exactly. You're calling a spade, yeah. But you're not calling a spade in the investment grade space that's just gone bananas. 95% of those bonds are trading at a discount. That tells you something. It tells you that the market is properly pricing investment grade and that you are going to continue to see fallen angels coming up. And again, March 23rd, 2020, Jay Powell rode to the rescue. He said any BBB rated investment grade bond that is downgraded after March the 23rd, 2020 will be grandfathered in and given grace and not deemed to be junk. There's a reason that he was so specific about this particular rating of bonds. I don't see him doing that twice.
Yes, I remember speaking to you shortly after that because he got a lot of stick. And you said, well, he's not going to be allowed to get away with that a second time, was your opinion at the time. And I remember very specifically that because I still had that same investment on and I'm still holding it because I feel it's the end of a debt cycle and I should just endeavor to hold. And that was
Look, even if the Republicans should come to the rescue of the market, for a little while at least, if we can finally get them over the line to where they have the House of Representatives, they're going to want their pound of flesh. They're going to want their moment of redemption and revenge. And that's going to cloud their judgment going into 2024 to where they're not going to make anything easy for anybody. So for at least a little while into 2023, you're not going to have a Congress that's on the side of commerce. And people don't appreciate that. It's not that Republicans won't bend or spend more. When push comes to shove, they're just going to want their moment in the sun to say, we are going to, these last 2 years of humiliation, somebody's going to have to pay the price. And then they'll wake up in 2024 and figure out the damage that's been done.
Yes, it's almost like it pays them for this to be an economic dark year until the next election, because this is all on the Democrat watch still officially.
Exactly. They can't be blamed for it yet.
Yeah. No, it makes absolute sense. The title for the theme, Danielle, is that it's a great awakening. What have you found? What was the thing that came out since, say, the last time we spoke to you or a year ago? What is the biggest shoe that dropped for you? You said, my God, X, Y, Z, I now see this in terms of you, or that you've observed in others that they've kind of started to get a grip. I feel, and we were talking about debt markets, suddenly a lot of people are having to learn about debt markets. You so made the point just now, it's not about crypto, it's not about equities. Everybody understands that most people aren't conscious of debt markets. It's far bigger. My opinion is this is a cyclical turn, but I might be proven wrong. What's your great awakening point, and what have you seen in others as an awakening point that there's a dawning realization of?
So a few months ago, I took note that Bitcoin was no longer trading in lockstep with stocks. And it kind of hit this period of, it went into hibernation. And it was just very steady. And as they say, still waters run deep. And so that really caught my attention. Now, some people came out and said, well, this is a good sign. It's a sign that there's been an acceptance, that it's matured as an asset class, that it's not going to be volatile anymore. And then I said, but still waters run deep. So what if this is maybe instead a few nefarious players that have not yet been discovered? And that was kind of my epiphany. I didn't look, blind squirrels, right? We're all lucky.
Yeah.
But that was
Good
my
call.
moment when I said something is not kosher, something is not right with this picture. And then we had the next shoe that fell, and individuals who we thought were bulletproof all of a sudden weren't. And we're seeing bankruptcies that even I never expected in the space. And to me, we will all look back and remember this moment because it could easily be associated with a timestamp of when the real party was over. We expected the value of some rap star's Mars, a blueprint that was being exchanged for millions of dollars. We expected those values to fall out of bed. We knew SPACs were BS. We knew. But there's been this faith that there is some value in the DeFi space, some value in the crypto space, and that there is, this is the revolution fighting against fiat, I mean, it all sounds good.
Yeah, it's a good story.
Here we are with being a wee bit disabused of our notions. And that really has surprised me. And if you start to get to where you're in a price discovery mode in general across asset classes, that to me is when you start to see the credit cycle really kick in.
Yeah. Yeah, so a bit of the shine coming off the new money system that's been sold. But the Bitcoiners will tell you Bitcoin did no damage. That's because you were in centralized exchanges. You weren't trading trustless. Our standing, our belief system still holds. Not your keys, not your wallet, not your coins. All of these things. They'll stand almost defiant and at the moment in this environment. But you can't help but think that crypto's definitely been injured badly by this major centralized exchange failing.
Well, even people I know, I will name no names. They're like, if this puppy breaks 10,000, I'm coming in with two hands and buying everything I can.
Okay, so there's actually a bull theme underlying that, an undervaluation and some bargain basement fishing that you think from big players. That's interesting. That is interesting. But what if we're having this because macro has dominated crypto recently to a large degree. I mean, I actually very unfriendly, just to antagonize all my Bitcoin friends, because I'm part for and against. I'm trying to always be dispassionate. Did a ARK ETF chart overlay on Bitcoin, and actually the ARK ETF, which is a very high volatility, badly performing as you're aware, was the lower beta earlier indicator for every down move that Bitcoin took. So crypto, its god market, the big boy, the grandfather Bitcoin, actually was a high beta lagging performer to what is actually deemed a very speculative equity. And that was kind of humiliating because it's sort of putting the schoolboys in order of height. And they were junior graders in that essence. For that period under review, understandably, which was the blow-off of the March 2020 liquidity. And a lot of it occurred on the liquidity of that era, and the dollar weakening. And now we've had a lot stronger dollar, and it's actually been very, very disappointing in its general performance.
It has, and I mean the word disappointing, I think, is a central theme, and I'm taking a step back here and saying that because almost every investment is perceived as, well, at some point Powell's going to bend, and that therefore there's this optimism that's out there that he won't let it hurt that bad. That underpins the philosophy of modern day investors, because it's all they've known. You have to get somebody that's older than you and me to have been in the trenches in the 80s and can remember when somebody like Paul Volcker really didn't care what markets did or didn't do. And if Powell really is dead set on that, barring a systemic event, then investors have to find a new way of approaching investing, regardless of what the asset class is. And that's a hard lesson.
Yeah, it is. But it's been to buy the damn dip. It's a 40-year meme, not an investment strategy. And it's, Larry Summers, who's someone I don't always personally think I like his gender, but he's someone who's worth listening to as a very powerful force and voice, was saying it's very important, and I've always figured him to be more of a Democrat than a Republican, but let's not get involved in the left versus right. He was saying Powell should not want to be remembered for being weak on inflation. The words to the effect of, he needs to be a Faulkner, not a Burns, I think was the gist of his historical reference.
Highly critical, yes.
And it seemed like he was leaning on, you better be a hawk or history will remember you very poorly. And that was quite a lot of psychological play and pressure from somebody who was, had a number of very significant roles in.
He's a strong voice, and he's campaigning to be Treasury Secretary. Bless his heart.
Yes, indeed. So that kind of also points to Powell needing to stay out in front of the avalanche and keep leading the way. And it does seem like we tighten until we break. I kind of talk about it as it's like walking the plank that tapers to a point, and the one side you fall off is the recession rolling into Great Depression, and the other side is you fall off into not tightening enough and runaway inflation. And I kind of feel that he's going to walk right off the edge where you effectively fall off both, where the point is, because he has to keep walking and he has to fall over one of those sides. And it seems like we just tighten until things break. And it's got to be a debt market. It's got to be a debt market of its interest rate, or maybe derivatives, exposures, and banks. Could it be that?
We don't know. We have no way of knowing, do we?
No.
And just to see, to use a micro example, just to see in the last reporting season, big banks, the 24 largest banks, they took up their loan loss provisions from 3 to 3.9 billion. And then of the next 40 largest banks, between 50 and 100 billion in assets, 24 took increased loan loss provisions. 32 of the 40 maintained high provisions. It's extraordinary to see the assumption, the accepted assumption that unlike the last cycle, unlike headed into the great financial crisis, the banking system is so much more resilient than it was. And I say, well, then why are they setting aside so much money for future losses? And it's because everybody misbehaves from cycle to cycle. They just don't necessarily misbehave in the same exact way.
Yeah. I agree. I don't believe that the banks have got suddenly infinitely more robust. In fact, on that point, after the last time we spoke, because I would have loved to have asked you when this happened, I'm now referring to news flow that came out some time ago, but was absolutely extreme in the scale of money that was provided not only to US banks, but to Swiss and European banks. And then the news just got stamped out. And it was very hush-hush. And I thought there's something behind that, and it was really quelled. And it seems like news that shouldn't have got out. Fed providing trillions to individual banks, including Swiss banks. Surely this was taping together derivative exposures of some sort. What's your take on that? And that, I mean, you just spoke about something that was 3 billion being raised to 3.9 billion. That's essentially 1 billion. Some of the numbers that were provided to individual Swiss banks were in the 2.3, 2.8 trillions, not just US institutions. And it just got killed, that story. And I wanted to follow up. And I was saying, surely this is masking tape around an imploding system that is just holding something together a little longer until it's almost ready to fail. Where we were then, what was your read on that?
No, look, where there's smoke, there is fire. I was actually in Geneva when those few little headlines, and you're right, they were quashed, when those few headlines were trickling out. And I've never seen the financial media work so hard to bury a story as you saw across the Wall Street Journal, the Financial Times, Bloomberg, all of them just kind of whisked it away as if nothing was happening. The Federal Reserve quietly, it broadened out the umbrella of countries that could come to it if in need of assistance. And you're like, well, wait a minute. Are we not watching the implosion of developed economies that we would normally have associated these types of events with emerging markets?
Yeah.
And yet here we are, and all the way to Switzerland, where I was. So there is something to be said for the fragility of the financial system, and the reason that Jay Powell has been able to continue down this warpath. I think it's because he was able to successfully cauterize the wound that was overseas and then move on. But that does not mean that there was not a grave wound inflicted.
But the
Yeah, overseas
size,
bank.
the size was just so vast, and the fact that they managed to kill the story, it literally came out, just tells me that there's way more that should be being discussed about it that isn't understood. You don't even see the question asked in the Fed meeting. How is it
No.
you printed American people's currency and provided in trillions to individual institutions in Europe? Is this, what kind of does this point? Is this the offshore dollar market? We're talking euro dollar market?
Remember, nobody wants to talk about the euro dollar market.
Yeah.
It's like Voldemort. Nobody wants to talk about it because it's so damn big. And when you go down that rabbit hole, you start to talk about developed economy reserves and what they've got in terms of a cushion. These are insane discussions in theory to have, and yet here we are. But the presumption that global central banks were going to be able to become vast holders of Apple stock and huge stock market investors, and everybody does quantitative easing, and nobody ever has to pay a price. The world that we were living on was predicated on such ridiculous assumptions to begin with that you end up having to go back to the Federal Reserve and saying, oh, $1 trillion here, $1 trillion there. That's what it's come to. But the stakes are too high for the Fed to not be doing something in the background. And yet, when he's asked, when he's at the podium, if monetary policy is being crafted in such a way as to be cognizant of international peers, Jay Powell basically says, it's their problem, not mine. And he moves forward with extraordinarily, the first 75 basis point rate hike, Christine Lagarde was burning up the phone saying, for heaven's sake, don't do this. Do you know the destruction you're going to cause? And off he went into the sunset and did just that. Can you imagine a Yellen or a Bernanke having been so uncouth? And yet he did.
Yeah, and he did it. He then said he's not imagining having to do it too often, and did 4 in a row.
Exactly.
Yeah, it's unbelievable. It's
in
unbelievable.
A Euro-dollar world, when all this when all this debt is dominated, and you look, there's, compared to the GDP of the United States, 24% globally. Our footprint as in the dollar in debt markets is just magnitudes of that, and people don't grasp it. They don't understand, why has the dollar been so strong? Because it's everywhere. There's no damn alternative.
Yeah, it's true. And does it revert back to the that level of strength? Because our house view is that it's having a correction after a substantial move, but that the dynamics that have driven it haven't gone away, even though inflation...
What's the alternative?
Yeah.
There's still no answer. There's no answer to the question. What's the alternative? That has not changed overnight. And you can have a consolidation. That's rational. Fine.
The growing development of the BRICS alternative is going to take far longer to take heed because it has to be proliferated and pushed into every cupboard and corner where dollar exists so that it actually becomes a viable alternative. Just because you create it doesn't mean it's proliferated. It's almost like the Betamax. Yeah. Sorry, carry on.
China's relying on COVID zero policy to not have to tell the rest of the world that it's run out of money.
Yeah.
It's obvious. And that would be the only potential alternative, because we've lost faith in the yen and the euro is a joke. God knows what happened in the UK.
Yeah.
So, and China's broke, and they don't want to admit they're broke. So instead they lock their people down. So for the moment, it's just a matter of there not being an alternative. It's not rational, but it is what it is.
I like that you brought up China, because it's my overall opinion that we have insufficient coverage of the extremity of the property implosion there that I think would embarrass even 2008's biggest sins of ninja loans and beyond, in terms of leverage upon leverage upon leverage. I've gone into a few things, but we just don't seem to get that news flow. And when we're talking about least dirty shirt, as bad as things are, we just haven't seen how muddy the Chinese shirt is. Because we were on a Hong Kong dollar peg failure. We're expecting that to take place at some point.
We're not going to see it. We are not going to see it. It's by design. It is a contained insulated, isolated in a vacuum financial system. And the fallout, if it was an open system with the rest of the world, would be magnificent. And we have no idea of what it is, except for the fact that in the United States, sellers, owners, holders of commercial real estate refuse to sell anything. They do not want a price tag attached to any building, because then you know what the other buildings are worth. And yet, the one thing that we do see in Midtown Manhattan and in Los Angeles is that Chinese companies are coming in and selling entire buildings in the United States to raise funds. So we quietly have in our face how bad the situation is in China, because they're resorting to desperate measures in order to raise liquidity by selling properties here in the United States, much to the chagrin of the commercial real estate community here stateside.
That's fascinating information. So it's almost like the Japanese attempting to maintain the debt markets. It's gone no bid, and they're the sole buyer, and they're encouraging it's a no volume market in China. And what they're actually doing is they're having to, because that's a really useful anecdote, not being in the stateside, knowing that China is divesting from property investments in America is very, very useful. And it is a...
Well, that's, I mean, think about the ripple effects on residential real estate markets that are much worse than the United States was in 2007. Think about Canada. Think about Australia, New Zealand. Think about, I don't know, name the Nordic.
Yeah.
Think about all of these property markets on the residential side, where they've got variable rate mortgages that are staring down not a global recession, but internally, domestically, they're staring down balance sheet recessions, because your marginal international buyer has vanished.
Yes, that was a huge. So listening to you talk on China, surely, because we were short Hang Seng for a while, we had a great setup and trade, and we are awaiting the failure of the Hong Kong dollar, and we've also been leaning a bit on the Chinese and the Japanese currency. Those should resume, given the level and the degree of decay is almost, it sounds like multiples worse. And will fall sooner because they don't have the executive privilege of global dollar. Because we still have, I keep stress testing our hypothesis, we'll actually have a spike strength in the dollar at some point with almost globalized contagion, failure of banks. It will come, US will be last. It'll sort of from the periphery first and the most over indebted, which could include the likes of China and their currency first. And at that point, I think they launch the BRICS and they start talking about how much gold they've got, and maybe they'll do something to counteract a contagion to get some strength. But where would you pick holes in our hypothesis? Is there a Hong Kong peg failure? Is that a good bet, or is it?
There could be, but we have to bear in mind that Wall Street, the sell side, has been predicting incorrectly that stimulus was going to be deployed in China, and it has yet to happen. And that tells us something, because China is not, I call them broke.
True, yeah.
China's got some ammunition stored up. And I think that you could see a pop in commodities inflation at some point, because China does have something set aside to make sure that there's not a complete implosion. But long term, your hypothesis holds.
Yeah.
And people need to appreciate and realize that all of the photo taking moments between Xi Jinping and Vladimir Putin at the Olympics, how quickly we forget. And it's, China has discovered that, oh my gosh, our ally is not what we thought our ally was. And so there's that realization that they're going at it alone in the world. And so they have to be careful with what they have in terms of deploying stimulus. But there's something in the chamber.
Yeah. And I think it's the gold.
It's simply not there.
I like the idea of the gold that they have, but there's also the US treasuries, which they have already, I assess, been selling. So first they were selling them quietly. Everybody was, to try control the dollar strength. And then they started talking more overtly about it to try jawbone it down, which tells you that they've already been doing it for a while, but now they want to really amplify it. And now we have this patch of weakness and pullback on the inflation number. But how much more can they get rid of? And is it not a case that if every nation state is doing something similar, all US debt ends up being repatriated back onto the Fed's book or other US-based buyers? Who else is the bid outside of America for treasuries in an environment where the dollar is getting strong again?
So I think I'm going to counter your hypothesis by saying that the debacle of UK pensions has likely frightened some life insurance companies and likely frightened some big, huge pensions. And that there is going to be a scramble to get into safe treasuries with these high interest rates in this environment as the alternatives that these pensions hold, that these pensions hold, as the values get called into question, that there's going to be a very natural buyer of treasuries given where yields are, especially if Jay Powell can hold them at that high level. And we won't necessarily see the obviousness of China liquidating its treasury portfolio because they've methodically for the last decade been shortening the maturity structure of their treasury holdings such that they don't necessarily have to be outright sellers.
Okay.
They can just let them mature, just like the Fed.
Yeah. Okay, so there's probably a slow dribble out maturing approach, and potentially you think, I mean, it's just, is the UK pension system big enough to be, well, I suppose it won't only be the UK, could also be Euroland, because of course the European debt is also lagging the British. So maybe
we just had a town in Pennsylvania declare bankruptcy. I posit that that's not the first town that's going to declare bankruptcy because of its pension being so underfunded. And we have yet to see the pensions mark to market their illiquid holdings. And that's what pensions have never had to do. And people, Francis, think about the size of the non-bank market globally is 220 some odd trillion dollars. The size of the conventional banking system is closer to $180 trillion. This is a 2020 timestamp. But we have not in our lifetimes been forced to actually write what these private holdings are actually worth, because the Fed has always bended. The Fed has always pulled a Mario Draghi, whatever we need to do, and not forced that moment. But imagine where we would be if these private holdings had to actually be recognized for what they're worth in the public pension world. I mean, that would be absolutely, it would be Armageddon. And private equity firms are lobbying in the background. They're the ones who are screaming the loudest for Powell to pivot, because they've never actually had a moment where their investors have had to recognize how little their holdings are worth, because the Fed's always ridden to the rescue and opened those capital markets back up so that they had their exit paths. Yeah,
it feels to me that the world over has overvalued assets, particularly in the debt market, that aren't being marked to true value. And we have a major downswing, and this is going to be hyper deflationary, of course, because it's the destruction of money if you get such negative re-ratings to the downside. Danielle DiMartino Booth,
you've just slayed about 5 different sacred cows in one sentence.
Possibly. Yeah.
Nobody wants to talk about anything you just said.
Yeah, I'd love to know your, given on that cheery note, I'd love to know your big forecast and positional advisory that you'll go on a non-advisory base. But what would you say to our reset community, our trading community, our investment community that wants to come out of this economic travail time period without being absolutely a busted flush? How should they position for 2023 with all these threats, all these mark-to-markets that have yet to happen that should see a re-rating astronomically lower? How should they position? What is the best place to be?
So I have to say, just color me stupid, because I cannot figure out the VIX. That being said, I think rates volatility especially in the aftermath of this magnificent rally that we've seen in treasuries. I mean, everybody was talking, oh, the NASDAQ was up 7.5%. The world as we know it, this is dawn of a new age. And I'm like, did you see the rally in treasuries? So we haven't had a flight to quality in a very long time. You've had bonds and stocks fall out of bed synchronously. So there's something to be said for, are we finally to the point where there's a recognition in the sovereign bond market that it's going to be so bad that you actually have to go back to the old playbook of that flight to quality at the long end of the treasury curve? So if we're there, God help us. And we've only had a recession. We have not had a financial crisis.
Not yet.
It doesn't matter if you have deep deflation. If you do have a financial crisis, and I think the two of us are sitting here talking about debt being incorrectly priced. So if we do have a financial crisis of any kind, for heaven's sake, gold will shine.
Yeah.
Your precious metals will shine. Finally, they will come out of a deep hibernation. And again, that's even if we have deflation. People seem to associate, you can only have precious metals shine if there's an inflationary backdrop. That's not true. If there's no place else to hide, your precious metals can shine.
Absolutely. I concur.
I repeat that there are two sides to every trade. I'm not saying to go out and be short the QQQs. I'm not saying that. I have a dog right in front of me. You're very cute.
Oh, bless.
I'm not saying that you have to go out and short the market and lose your shorts, but I am saying that there are two sides to every trade. In March, we said, anything associated with the U.S. auto market, you need to be on the other side of that trade. Yeah. We have yet to be proven wrong there. It's just the beginning of the repossession cycle here in the United States, where loan to values for cars were 140%.
Absolutely.
And used car.
And the shotgun finance deals that everybody signed for them, the 7-year deals with buying 60% of it with balloon payment. Absolutely.
Why not have an 84-month term loan? Why not? Sure. It's like a damn house.
It is a house. Danielle, it's been fascinating as ever talking with you. How do people find your amazing information and get to follow your wisdoms?
So they go to quillintelligence.com. Few people believe that. Like, what do you mean it's $60 a month? And I'm like, I'm that cheap. That didn't sound right. But come to quillintelligence.com, subscribe, become a Daily Feather subscriber, and follow me on Twitter, which is absolutely free of charge, at DiMartino Booth. And there's always a font of wisdom out there, because I think I can tweet in my sleep.
Excellent. I love hearing what you have to say. It's always insightful. Thanks for all the interesting anecdotes, the Chinese selling off their US, all of these real pressures. These are rivets that are popping on this great machine, the submarine of ours. Really a pleasure to have you on. Thank you again for coming on. And everyone should check you out at Quill Intelligence. Is it? Quill Report, the Feather, the Daily
Quill
Feather.
Intelligence, quillintelligence.com, yes.
Excellent. Thank you so much, Danielle. We look forward to talking again soon. God bless.
Thank you. Likewise.
Bye-bye.